This guy allegedly made up to $1 million trading Nvidia stock just 7 days before his own administration approved a massive chip deal with China. His name is Donald Trump, a multi-billionaire mogul and the ultimate master of asymmetric corporate leverage. But we are not just talking about old real estate deals or basic political corruption. In this video, you're going to see the exact mechanical blueprint of how Trump turned the federal government into the ultimate high-frequency trading algorithm, how his inner circle legally completely blocked the IRS from ever auditing his personal wealth again, and the specific loophole that allows a billionaire to execute over 3,600 private stock trades in a single quarter with absolute legal immunity. And here's the truth. He didn't follow a single piece of conventional business wisdom to become this successful. Throughout his career, he has executed calculated, highly questionable moves that would ruin an ordinary executive, but they've propelled him to the absolute top. He is, without a doubt, one of the most ruthless operators in modern history. In this video, we are breaking down part 2 of his craziest business playbook. These are the modern moves that established Trump as one of the most controversial bosses of all time. If you're trying to build a real business or want to become a corporate overlord, watch till the end. A 113-page federal ethics disclosure revealed that his accounts executed a staggering 3,642 stock trades in a single quarter, averaging about 60 transactions every single trading day, moving up to $750 million. While ordinary citizens wait for public policy announcements, Trump's automated portfolio built massive multi-million-dollar positions in Nvidia and tech giants right before his administration loosened chip export restrictions to China. The jaw-dropping element here isn't just the inside access, it's the legal defense mechanic. Under federal law, if an executive misses the mandatory 45-day reporting deadline for a trade, the government slaps them with a nominal, laughably small $200 fine per violation, a fee his high-volume accounts can simply pay as a basic, cheap cost of doing business. This modern high-speed play is the direct evolution of the aggressive green mail tactics Trump mastered in the 1980s. Back then, he would quietly buy up a threatening percentage of a public company's stock, intentionally leak to the media that he was planning a hostile takeover, and watch the terrified corporate board panic and buy his shares back at a massive premium just to make him go away. In the early 1990s, Trump's casino and hotel businesses were heavily leveraged. When the market turned, the debt became unsustainable. Trump used it. Through multiple corporate bankruptcies, he renegotiated debt, reduced obligations, and kept control of key assets. Lenders took losses, but they also had incentive to keep the business alive rather than force total collapse. The system allowed him to restructure without being personally wiped out. It was using legal structure to absorb it. When deals are large enough, bankruptcy isn't always the end. Sometimes it's a reset button. In 2026, Donald Trump escalated conflict with Iran, moving beyond diplomacy into direct military and economic pressure. But the move wasn't just military. It targeted the Strait of Hormuz, one of the most critical oil routes in the world, responsible for a major share of global energy flow. By threatening and partially controlling that route, the U.S. wasn't just confronting Iran, it was influencing global oil supply. That immediately pushed energy prices higher, disrupted supply chains, and forced global businesses into uncertainty. It was pressure applied at the economic choke point of the world. It was leveraging geography to influence global markets. When you control the bottleneck, you don't just fight an opponent, you affect everyone connected to the system. When Trump developed Trump Tower in the early 1980s, he wasn't waiting for the building to be finished before making money. Before construction was complete, units were marketed aggressively using luxury positioning, celebrity association, and media coverage. The building was framed as a symbol of status, not just a place to live. People weren't buying square footage. They were buying into a narrative. That allowed Trump to secure deposits and commitments before the asset was fully built. That early cash reduced financing pressure and validated demand publicly. If the project slowed, he already had buyers locked in. If it accelerated, he benefited from momentum he created himself. It was monetizing demand before delivery. Early on, Trump wasn't just building properties. He started putting his name on them. Trump Tower, Trump Plaza, Trump Hotels. But it was a shift in business model. Instead of only making money from owning real estate, he began licensing the Trump brand to other developers. They built the projects. He provided the name, marketing, and perceived prestige. That meant lower capital risk with continued upside. If the project succeeded, he earned fees and visibility. If it failed, his financial exposure was limited compared to full ownership. It was turning identity into a monetizable brand. One of Trump's earliest major projects was the redevelopment of the Commodore Hotel in New York. The building was losing money, the area was declining, and lenders weren't eager to take on the risk. Trump didn't. He negotiated a long-term tax abatement from the city, significantly reducing the project's costs. Then he partnered with Hyatt to bring credibility and secure financing. Lower taxes improved margins. The hotel brand increased trust. Financing became possible. What looked like a bad deal became viable through structure. The tactic wasn't finding a perfect opportunity. It was reshaping the economics until the deal made sense. After taking heavy financial hits in the early 1990s, Trump changed how he expanded. Instead of putting his own capital into every new project, he shifted to licensing the Trump name to developers across different markets. These developers funded construction and carried most of the financial risk, while Trump provided the brand, positioning, and perceived prestige. This allowed him to be involved in multiple high-value projects without locking up large amounts of capital in any single deal. If a project succeeded, he earned fees and strengthened global brand recognition. If it struggled, the downside didn't hit him the same way it would under full ownership. It was expanding influence without tying up capital. As Trump moved into larger real estate projects, he didn't rely on fully owning assets with his own money. He used debt aggressively to control properties that were far larger than what his personal capital alone could support. Banks financed significant portions of his deals because the projects themselves had potential upside. As long as the asset value held or increased, the structure worked in his favor. He controlled high-value properties while putting in a fraction of the total cost. If the deal succeeded, returns were multiplied because he controlled a large asset with limited equity. If it failed, the debt pressure became severe, which is exactly what happened during downturns. It was using leverage to access scale early. In the early 1990s, Trump's business was under real pressure. Banks had already lent him massive amounts of money. If he went down, they took major losses. That gave him leverage. He negotiated restructures, extended timelines, and in some cases reduced obligations, while still staying involved in key assets. He wasn't negotiating from strength, he was negotiating from consequence. It was using pressure to force better terms. By the time Trump entered politics, he wasn't just a businessman. He was a brand with decades of built-in recognition. Most candidates build visibility during a campaign. He started with it. The audience already knew the name, the persona, and the tone. He applied the same playbook from business: control attention. Whether positive or negative, visibility stayed high, and that visibility translated into influence. What began as business branding extended into political capital. It was transferring attention from one domain into another and converting it into power. You made it this far. Here's the most ruthless move that ties everything together. Trump faced criticism, backlash, lawsuits, and negative headlines that would normally force most businessmen to step back and go quiet. He didn't. He stayed in the spotlight. Instead of treating controversy as damage, he treated it as fuel. News cycles kept repeating his name. Every reaction created more coverage. Every headline extended reach. The conversation never fully moved on. Constant visibility without paying for it. Whether people agreed or disagreed didn't change the outcome. Attention stayed locked. And when attention stays locked, every business move, every announcement, every deal travels further. Media exposure fed brand recognition. Brand recognition fed opportunities. Opportunities fed more exposure. The tactic wasn't controlling the narrative perfectly. But if you think Trump's playbook for absolute dominance is aggressive, he is amateur hour compared to the tech billionaire who pioneered the modern corporate shakedown. In our next breakdown, we are pulling back the curtain on Oracle founder Larry Ellison, the original Silicon Valley pirate. We're going to dissect his latest vicious moves, from masterminding massive hostile takeovers of legacy media to aggressively cornering the AI cloud infrastructure market to add a staggering $71 billion to his fortune in a single month. If you want to see how a tech titan corners entire global systems by treating law, data, and massive computational power as a game of raw leverage, you won't want to miss it. Hit subscribe, and we'll see you in the next one.